back and please open the file number 2. Let's do the historical analysis of these items and then we'll move on to the projection part. So please open file number 2. So please open file number 2. What we're going to do in this sheet is we are going to analyze the historical data points. So we are going to analyze not only the P&L related items but also the balance sheet related items. So I'll come to the balance sheet part a little later in this sheet, but let us first start with the revenue assumptions. So what I've done, let's say I'm working in this company and I've got these data points that how my revenue was generated. So I've taken the details about the sale price of the components that I'm selling, like I'm selling cameras, I'm selling accessories and all that stuff. So I put the sales price out here and also the volume, right? So because I know that my revenue from camera is nothing but the price per camera multiplied by the number of cameras that I've sold in a particular year. So it's going to be the price into volume game. That's how it works. So I want to see what has been the historical year-on-year increase in the sale price and also in the volume. So if at all you need to work out the year-on-year increase, what we can do, as we discussed in the last class as well, that the year-on-year increase is essentially the current year divided by previous year minus 1. You basically take the current year divided by previous year minus 1, because the idea is that you could take the gap, like it was 400 and now it is 420. So the gap is 20 on a base of 400, which is 5%. Or you could straight away take 420 divided by 400, which gives you a multiple as compared to the last year, and you do a minus 1, which also talks about or gives you the same result. So that's what I've put over here as the current year number 420 divided by the previous year number minus 1. Then you drag it on the right hand side as well to be able to see the historical growth in the sales price. So you can see that it has increased at a rate of roughly about 5% year on year in the last 2 years. Let's copy the same formula down to be able to see the increase in the price of accessories. So you could see that it has increased drastically. 12% in the year 2017 and 25% healthy increase in the year 2018. Let's look at the volume as well. Now the volume growth is phenomenal. If you see the camera volume increased by almost 100%, which means that it doubled in the year 2017 in terms of our sale. And then again it increased by 74%. So this company has seen huge increase in terms of the volume. And on the accessory segment as well, the company witnessed 150% increase in the year 2017, but in the last year it was pretty much flat. So we couldn't grow. It was just about 1.9%. It's pretty flat over here. That's on the revenue part, which covers your sales price and sales volume. Now, what is the biggest component in your cost? For a manufacturing company, it is definitely the raw material component, right? So we have the raw material component out here, that what is the raw material cost of the components that I'm using in cameras and also the ones that I'm using in accessories. So let's copy and paste the same formula and figure out the year-on-year increase. If you see, the trend is not very clear, because in the first year 2017 the cameras raw material increased by roughly about 33%. It's quite a big jump, but in the next year it was pretty much consistent, less than 10%. It's roughly about 8%, a single digit growth, which is understandable, but this 33% is pretty huge, right? There could be a possibility that there was some increases because of certain market pressures, because of which the company's cost went up drastically, right? And then in the accessory segment also, you see that the cost of the raw material almost doubled and again half. It is almost the same that it was 2 years back, but then from $5.50 per item, it increased to roughly 11 and then again went back to $5 number. So it's almost flat if you look at the last 2 years time frame. So in 1 year it increased by a normal number and then it decreased by a normal number. So it seems that there was some temporary jump which happened in the year 2007, which got nullified in the next year itself. Right. So we have seen the broad components of the year-on-year increase out here. So what we need to do next? We need to look at the other cost components, because in the P&L you have revenue, which we have covered. In the operating cost you have got the raw material cost, and then there is this research and development, sales and marketing, and G&A as well. So now is the time to look at those numbers and see what number these are as compared to some other related parameters. Now, usually what happens is the research and development plan of a company is decided by itself as to how it intends to spend that amount in terms of developing a product and improvising it. So it keeps on spending some amount on the research and development. Now, if you see that the company is spending some amount on R&D, it is doing it with an expectation that if it does that spend, then it will be able to improvise the quality of the product, bring new features, which would help it generate better revenue in future, either in the form of a higher volume, or it will help the company to command a higher price for a better product. So this R&D is usually a personal call of the company, but then at the same time, if you have to take a decision that the company's sales is increasing, so obviously it would be willing to spend more amount on the R&D because it has got good amount of sales coming from the market. So you would see many a times that the research and development cost and also the advertisement cost or other sales and marketing expenses are usually connected as a percentage of sale. So you would pick that number and connect that to a percentage of sale. That is going to give you a broad sense as to what amount of your total sales you are spending on these items. All right. So I have got the research and development, sales and marketing, and the G&A expenses here. I'm going to connect that as a percentage of sales just to be able to broadly see that what portion of my sale is going to fund the research and development, sales and marketing, and the common office expenses in G&A. So every time I have to take the data from the numerator out here and divide it by the sales that I've got in the P&L. So if I take you to the P&L sheet, we've got the total sales in the row number 7. But bear in mind that there is a disconnect in terms of unit. So Vishakhi, G&A is general and administration expenses, something related to your office cost. That is what we call as G&A. So what you have over here in the P&L is the revenue in the row number 7 is given in the USD million. However, out here, I've got the research and development expenses as an absolute USD. I could also pick this data from here because the same research and development expenses are mentioned here, also the sales and marketing and the G&A expenses. All of these values have been given in the P&L also. Or if you have put it here for ease of reference, then make sure that when you compare it, you put a dollar sign appropriately to call out the same data from the row number 7, which is sales, and also convert the units. So what I need to do is, this is my total absolute data. I'm going to convert that to a million, which you could do by dividing it by 10 raised to the power 6. So I'm going to put the research and development cost divided by 10 raised to the power 6 so that it gets converted to USD million, and then divided by the total revenue that I've got here in row number 7. Now mind one thing, that the revenue in the row number 7 is going to remain constant. When you go down, you would want to refer to row number 7 every time, right? Because whether it is R&D or sales and marketing or general and administration expenses, every time in the denominator, I want to take the total sales, and that's there in row number 7. So I'm going to fix the row number 7, but because E is for 2016, and as we go on the right hand side, we would want E to be shifted to F and then eventually to G. So put the dollar sign in such a way that you're able to copy and paste it across the rows. So let me show you the formula here. And so how do you take the power 6? It's basically the caret sign, Vishakhi. It's above number 6. So you could use shift and 6, it will bring that caret sign. So usually in the keyboard, just above the 6, we have this caret sign, which is used. And this formula you could paste at other places as well. And now you can make some sense out of it as to how this is behaving as a percentage of sales. Like the research and development, as you can notice from the trend, it has been usually in the range of about 7, 8%, 9%. The sales and marketing is roughly about 20%, 22%. The G&A expenses are in the range of about 3 to 3.5%. All right. So take a minute. I'll take a pause here for you to complete this stage before moving ahead. So work on it, and then we'll move to the balance sheet component. Uh, First of all, see that what is the formula that I have to put here. So basically in this case, I have to put a formula which picks the data from the cell above and then divided by the sales number. Every time I copy and paste my formula down, I would want the same sales data to be taken in the other rows as well. So the sales data is given in row number 7. So when I copy and paste this formula for the percentage for the other items, still I would want to refer to row number 7, which means that the reference to row number 7 must be fixed. That's why we are fixing row number 7. But why we are not fixing the row? Why we are not fixing the column? Because the column E is for the year 2016, and when you go on the right hand side, this must change to column F and G. That's the logic behind putting $7 by fixing only the row number 7 and not the column E.
Hi sir, Amandeep.
Yes.
I am Kaushik Siddharth.
Yes, please.
Yeah, I'm Kaushik. I cannot understand that formula. This assumptions you are dividing by which I cannot understand this.
Okay, let me repeat that again. So what I was saying that in this case, I'm just trying to compare the research and development, sales and marketing, and G&A as a percentage of sales.
Okay.
So the base data points are already given here in the row number 35, 37, and 39.
Okay.
Right? So these are already given. These are absolute USD numbers. So I am just dividing all of these numbers by a million, because the denominator, when I'm bringing the sales from P&L, if you not notice here, the data points are given in USD million already in this sheet.
Okay.
So you cannot compare the absolute USD with the USD million data. So first I am dividing the numerator by a million, which is nothing but 10 raised to the power 6, because 1 million has got 6 zeros. So I'm taking 10 raised to the power 6 to be able to convert the absolute USD in USD million.
Million, okay.
And then in the next stage, you divide that by the sales number which is there in the P&L. And when you pick the sales number from P&L, you need to make sure that you fix row number 7, because you have to copy and paste this data down as well. The formula that I'm writing for the research and development, I have to write this for the sales and marketing and eventually for G&A as well. So we must fix that reference to row number 7 in the P&L. That's why we put $7, and the dollar sign is technically used for fixing a particular component of the
component. And the 7 means where it is actually 7 row, where associated with 7 is associated with which line in the sales and marketing of the P&L.
I'm sorry, repeat your question.
The 7 you are written on that formula. 7 that is related to the marketing of the
No. So this row number 7. Look at this formula again. Let me write it afresh. So what I'm doing, I'm taking this 18 million as an absolute value. and then
Okay.
I'm dividing it by 1 million. Now 1 million is basically 10
Yes,
monthly
convert to
hours,
million. Convert to
right?
million. Okay.
This is
Okay.
converted to million. Now you divide it by sales. Now where is sales? The sales is there in the P&L. In the P&L, I've got the sales in row number 7, which is there in
Okay. 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 That's what.
7.
That's what. The P&L and row number 7.
P&L
Okay.
E7, and then you fix only the row number 7, and it gives
Sales
you
means total revenue. Total revenue.
sales means total revenue. Sales means the total revenue which is there in the P&L.
Okay. Okay.
Revenue
Okay.
and sales are synonymous.
Okay. Okay. Now you are reciprocating the whole formulas in the all the rows.
Yes, and I'm trying to copy and paste the same formula for sales and marketing and for G&A as
Okay. Okay. G&A means what actually? G&A?
well. Journal and administration expenses, which covers your office related
Office
costs.
administrative. Okay. Office administrative. Okay. Thank
So
you.
journal and administration.
Thank you.
All right, so we are done to this stage. I hope there are no further questions related to it. We can move on to the top, which covers the balance sheet component. Now, this is very important because usually I've seen many financial models wherein people tend to commit a mistake in terms of projecting the balance sheet items. So, we are going to first of all figure out what is the historical trend that we have seen in terms of receivables, payables, and the other items which are there in the company. So I've got some balance sheet assumptions related to inventory, accounts receivable, and accounts payable. So let us pick it one by one. What I want to do, if you would like to find out the inventory days, that is usually 365 divided by inventory turnover ratio. That's what we typically do, right? So inventory turnover ratio is nothing but your cost of goods sold or maybe the raw material cost divided by, and when you take it in the denominator, it becomes multiply by average inventory. This is how we typically compute the inventory days. So what essentially are we trying to do here? We're just trying to see that what is the typical inventory size that we have kept and what is the number of days corresponding to the raw material cost that we have kept inventory in our company. So this formula indicates that particular piece, right? So how you could interpret this if I were to just insert a new worksheet and explain it. If you have to look at the inventory days, it covers a logic that, let's say if I go back to the balance sheet and show you the inventory number. Let's take an example and understand this. So the inventory is 60 and 112. So if I'm going to put in the sheet number 1 as inventory, this is for 2016 and this is 2017. Now this is the inventory balance in the balance sheet, right? And what's my raw material cost for the year 2017? I'll pick it from there that it is 300. Raw material cost is 300. So I'm going to say that my annual raw material cost, the annual raw material cost for the year 2017 is equal to 300. So what's my daily average raw material cost? The daily average raw material cost is 300 divided by 365, which is roughly about $0.8 million. Then I want to say that in this year I have maintained an average inventory of 86, right? I've maintained an average inventory of 86. So how many days of raw material cost does it correspond to? Because if one day is equal to 0.82 of cost, what cost would constitute 86? For how many days of the raw material cost would you get 86? That is nothing but 86 divided by 0.82. So what are we doing? If I show you the logic behind this, we are taking the average inventory. Inventory days is nothing but average inventory, and we are dividing it by the daily raw material cost. Now, if you proceed ahead, the daily raw material cost is basically the annual raw material cost divided by 365. This is how we are working it out. And when you open the bracket and get to the final part, it's nothing but 365 into average inventory by annual raw material cost, because the data from the denominator will come, or you could just leave it like this as well. So this is the formula that I'm using for the purpose of inventory days. And really, to your point, why we are taking average? Because balance sheet is essentially a moving item. It's a point in time item. So if you see the 2017, we go to the balance sheet in 2017, we closed at 112, but we would have opened with a balance of 60. So during the year, the movement from 60 to 112 is like up and down. So we don't know how this movement has been. So we typically take an average of opening and closing just to smooth out the movements which have happened during the year. So because 112 is at the end of the year, 60 is in the beginning of the year. So basically we take the average to be able to see the average number across the year which the company had. Right? Let me read a couple of more questions. Kiran, how do I arrive at 86? Okay, fair enough. Let me, a couple of you have got this question. Let's come back to this sheet. This 86 is basically the average. And then I've taken average divided by daily raw material cost. This is how it is being worked out, right? So how to use average formula? You simply write equal to average and it will work, right? So let me just come back here and write that formula for you. You would have a look at, you need to have a look at this. So it's basically equal to average, and then you take the average of 16 and 17 from the balance sheet. Yes. So the average of 60 and 112 is 86, which you take divided by, I'll take a bracket and then take the P&L, raw material cost divided by 365, and it gives me 105 days of inventory over here. So this is the formula that I put in this cell. Have a look at it, and then now you can give it a try to compute the accounts receivable days, accounts payable days, accrued liabilities days, and deferred revenue days, because the logic over here is going to be exactly the same. So accounts receivable days will be equal to average AR, or average accounts receivable, divided by annual sales divided by 365. This is how we can work out the ART. Accounts payable, you could do like this. Average AP divided by annual raw material cost divided by 365. So I've discussed the logic for the first formula. The logic for the remaining would remain the same. It is accrued So just have a look at the formula and give it a try, please, using these logics. So using these logics, please give it a try, and then we can take a small break after. So I've written the formula on the right hand side to be able to see the days for all of these items. So please see if you're able to compute these days using the balance sheet assumptions. And as I said, this is one of those items which I've seen many people tend to commit a mistake in terms of creating the financial model, because they use one approach while taking the balance sheet assumption and they take some other approach while creating the projection. So you need to remain consistent. Whatever logic you use for the historical data, just make sure that you are consistent in the future years as well. All right. So let's write this formula for others. Venkat, I will talk about the principle of consistency when I will cover the projections part. So maybe you could park this point for now. By consistency, just to briefly explain it right now, I am saying that for the historical data, I've used this formula, then you need to use the same formula in future as well. So don't change the assumption. Be consistent the way you have computed it in past. Use the same logic going forward as well. That's what I mean by consistency. So let's now do this computation, which is average of accounts receivable divided by the sales divided by 365. Let's do it for accounts payable. Yeah, I would. Yeah, Vishaki, I'll come back to your point. Just give me a second. Let me first write the formula here. So accounts so that others can work in the meanwhile. So accounts payable days, it's going to be the average of accounts payable divided by the raw material cost, 300 divided by 365. Then you take average accrued liabilities divided by 300 divided by 365. And lastly, it is average deferred revenue divided by revenue divided by 365. This is how we can work out all of these numbers. Now you can give it a try, use this formula to be able to create these values here, and in the meanwhile I would read out the questions which we have got. So first of all, Abhishek, you had asked this question that do we take the average of 60 and 112? Yes, we need to take the average inventory, not the ending or the year-end inventory. The practical logic for this, why we've taken the average of this and divided by the raw material cost of this. Okay, so Vishaki, to your point, and Prachi, I think you also have the same question, or Richie, you also have pretty much the similar question. What we are doing here, see, the P&L shows you the cost. If it is raw material cost, then it shows you the cost for the complete year. So right from day one of the year 2017 till the last date of that particular year, you would have spent some amount. So it gives you the total of that particular year. But the balance sheet is a point in time data. It gives you the data at the end of the year. So the end of the year data is usually a static data. So we usually need to take the average of opening and closing just to be able to see how it has moved during the year. Right? That's why we take the average of all the balance sheet numbers and we take the P&L number as it is. Make sense? Let me read other questions. So Vishaki, I hope this is clear now. Abhinandan, I see your formula you are taking in the denominator E10. So it is actually F10. You need to take the 2017 data. When you pick the the raw material cost, pick it from the year 2017. So Richie, why we took only the raw material cost in while computing the payables? The thing is that if you have any component to which you can relate to your payables, then pick all of those components, right? So there is no standard that you wouldn't take it for others. Sometimes you would see in the books that writers or authors tend to cover the concept of cost of goods sold. So cost of goods sold is basically going to cover each and every item which is related to your costing. So it could include your raw material cost plus other cost elements as well. So, but here I don't have the split of the other cost elements as to what portion of it is the raw material, apart from the raw material component, what is the other direct labor cost or what is the direct material cost. I don't have the other details, so I've connected it to only raw material cost. So it's more of a proxy, and here comes the important part that if you are taking raw material cost while talking about the historical trend, use the same number going forward as well. Be consistent. That's the essence. Okay. So, Meher, I believe your question is also answered now. You hope you're clear on the connect between the uh, various items that we are trying to combine here to work out the days. Vishaki, why not 2016 to 18? See, the thing is that if I'm trying to work out some number for 2017, then it's basically the opening of 17 and closing of 17. So look at the average this way. So opening of 17 is basically the closing of the last year. That's why we take the current year and the last year for the purpose of average. So Dipankar, to your point, why don't we take the average raw material cost between 16 and 17? See, the raw material cost is the cost that we incur during the year. P&L item indicates the amounts that you spend or you incur from day one of that year to the day 365 of that year. So it automatically covers the total number of that year. But balance sheet indicates the position as at one particular point of time. That is why we take average of only the balance sheet data and not the P&L. How do we know if these are good or bad numbers? See, there is no standard for it. For me, I may be looking to maintain an inventory of 3.5 months. My competitor may be maintaining an inventory of 2 months. Somebody else could be maintaining an inventory of 6 months. So there is no standard for it. It's a personal choice that the company makes depending on the sales pipeline that it sees, the way it is basically, seen in past that this is how my sales come up. So I would want to maintain an inventory of 2 months, 3 months, 4 months. So it is a decision, conscious decision taken by the company which it follows. But obviously, you could also compare it to what others are doing. In case you're creating a financial model, you may want to do that because you may see that right now I'm maintaining an inventory of 30 days, but going forward, I would like to maintain an inventory of 45 days. You can make that change, right? All right. So I think broadly, so yes, Prachi, as I said, for inventory days, it would be ideal to take the cost of goods sold. But in this example, I don't have the split of the other items which could form part of your cost of goods sold. So I compared it to the raw material cost. So that was the reason of taking only one component for that particular computation. Okay. So Amanpreet, your point is the deferred liability is zero. So we just have a deferred revenue. It is not essentially that you would always have a deferred tax asset or a deferred tax liability. So you may have some items in some companies and some items in some other companies. So in this case, I don't have anything in the deferred liability part. So that's why it's not taken out here, right? So the prepaid expenses and other current assets, if you see, I'm just going to bring it from the balance sheet and put it over here. So let us just see what we have out there. So prepaid expenses and other current assets, if you notice, number one, they're very small. In the overall scheme of things, they are pretty small. And number two, there is no movement, major movement that we have seen. It is roughly about 2022 only. So if there is a small item in the balance sheet and it is not moving substantially, and you can't really make any sense out of it in terms of trend, then the best option is that you keep it flat. Don't move it at all. Just keep it flat, right? That's how you can project it in the financial model. All right. So that's it on the sheet number 2. Let's take a small break of 10 minutes and be back at 11:35, and then we'll proceed further with the file number. All right. Thank you. We can get started. I'm back. Please open file number 3. And before that, let me read a couple of questions that we have. So let me see the questions. So Zian, to your point, a couple of questions you have. For what reason are we computing the number of days? So you'll get the answer to this question in the next sheet when I will work upon the balance sheet. So why we are using days, we are computing days, and how we are going to use it, we will see that in the next sheet. And when we say, for example, inventory days, what does it mean by that? So, okay, the second point I can cover right now. The second point says that the inventory days indicate the number of days for which the inventory is available. So, if it is 105, it indicates roughly for about 3.5 months of sales we would be able to meet with the help of the current inventory. Or you could say that the typical annual raw material cost that we have incurred given the amount of sales that we are generating corresponding to that 3.5 months of inventory is available with us. So in case there is a sudden demand, we have a stock available for those many days, a ready stock available for those many days, right? All right. And what about AR and AP? So that also indicates a pretty much similar stuff. So AR indicates the accounts receivable days, which means the kind of credit that we are giving to our customers. So if the AR day is, let's say, 70 days or 72 days, it's an indication that we are giving a credit of roughly about 2.5 months to our customers. So we do a sale today, but they come and give me cash after 70 days of time. Similarly, for AP, it means that I am buying something, I'm buying raw material from my vendors, but I'm giving them cash after 3.5 months. That's what the AP and AR days. All right, great. So let us proceed now. Please move on to the sheet number 3. And here, what we are going to do as a next step is we are going to take assumptions for the next couple of years. Now, somebody asked this question that why only 5 years. So I would like to clarify here that you need not stop yourself to just 5 years. If you are interested to basically create a financial model for a longer duration, you can do that. But the point is, the moment you go ahead and try to create a financial model for more than 5 years or more than 7 years, then you wouldn't really have quality inputs and assumptions to be taken for the subsequent years because that's too far ahead and we don't know what's going to happen at that point in time. So taking an assumption is basically slightly difficult for a period longer than 4 5 years. That's why you would see that mostly the financial models are created for 5 years time. Now, what I am going to do, and now Zian here, your question would also be answered to a certain extent, and completely it will be answered in the next file. How we're going to use these days? Just by looking at the historical data, we have been able to see that the company is maintaining an inventory of roughly about 105 to 106 days. So going forward also, if I have to project something, looking at the historical trend, I can say that going forward also I'm going to have the similar kind of inventory days because I would still be maintaining a 3.5 months equivalent of inventory going ahead as well. So what you could do, you could make it, or you could either take an average and then keep it constant, or you could also keep it constant as the same value which is over there. So take an average and then keep it constant.